Awesome. Haseeb, thanks for joining us today. Really
Thanks
appreciate
for
the
having
time
me.
and definitely always enjoy our conversations. I guess a quick intro to everyone. I'm Gil, president of Stanford Blockchain Accelerator, which I run together with Kun Peng, Stephen Willinger, with support from the Stanford Blockchain Club. We're part of the Stanford Blockchain Club, and we accelerate teams from either Stanford student or alumni teams building in the blockchain space. Our mission is to basically help drive blockchain adoption by supporting investment in and supporting on every aspect of building their blockchain ventures teams that are either enabling net new use cases or driving greater adoption and interest and users within the blockchain ecosystem. I also am a managing partner of the Blockchain Builders Fund, where we support and invest in teams in the blockchain ecosystem here at Stanford. With me is Haseeb Qureshi, managing partner of Dragonfly. Haseeb, why don't I let you give an intro to yourself? But actually, even what we like to do often is just have our guests give a little bit of a story of how they got into blockchain in the first place, and then
Sure.
kind of share a bit more about you and Dragonfly if you want, and then we can dive right into talking about product market fit in blockchain.
I'm happy to do that. So thank you again for having me, everybody. I'll try to be brief in my background because I could ramble for a while. The way I got into crypto was I'd first heard, so way before I got into the crypto industry or the tech industry, I used to be a professional poker player. Did that for 5 years, from when I was 16 years old till I turned 21. After I quit poker, I ended up finding my way into the tech industry. But a lot of my friends who continued to be professional poker players, uh, after the Department of Justice shut down a lot of online poker sites that I used to play on back when I was a poker player, people continued wanting to gamble online. And the way that they would play online, especially for high stakes poker games, is that they would settle their bets with Bitcoin. And that was how I first heard about Bitcoin. So this was like 2013. But at the time, I sort of thought of Bitcoin as, okay, this is a way for people to settle gambling debts online, or it's a way to like buy drugs on the internet. I didn't really think of it as anything more substantial than that. And so it was really in 2017 with the advent of Ethereum that I really started to grasp that there was something much bigger going on in this space. And I was working at Airbnb at that time as a software engineer, working on payments. And as a payments engineer, we paid people in 50, 60 plus countries around the world. And so it was my first experience working with the international payment system. And when you work on international payments, you realize very quickly that the experience you perceive as a consumer, which is that you swipe a credit card and then magically somebody on the other side of the world gets paid, that's an illusion. There is no international payment system. There are many different payment systems strewn all over the world, none of which talk to each other, none of which use the same standards, all of which were built like 50, 60 years ago. They're fucking awful. So it's like, CSVs being emailed, manually reconciled by hand at every midnight. There's places where there is no digital payment system. And so you're like mailing people checks into PO boxes, and then someone hits an API once they actually, it's a mess. It's an absolute mess. And, when I saw all this, like as an engineer, your instinct is that, oh, we should throw this away. We should start over. We should build a system that actually responds to the constraints of the world we live in, which is a 24/7 world that is digital first, that is always online, that is totally global. And it struck me that that's what crypto is. That's what crypto is trying to be. Crypto is an answer to the question of, if you could throw it all over and start over again, how would you build money differently? And that's what made me convinced that what happened in crypto was going to change the world. And so that's what got me to come into the space full time.
Awesome.
So that's my
I love it.
origin story. Yeah, that's my origin story. I've been an investor. I was very briefly, I was an engineer, I was an entrepreneur, and then I became an investor. I've been an investor now for coming up on 5 years in this space.
Sweet. And you've been an investor exclusively in blockchain, or
Correct.
or
I
more
only
broadly as
invest
well?
into blockchain and cryptocurrency startups.
Awesome. Sweet. Great. So you are indeed all in and have been. And I love your view on, like, this is the answer. I view that for blockchain in general is building public or shared digital infrastructure, which just doesn't exist in our world other than maybe the internet.
That's right.
Okay, so today is about product market fit. It's something that a topic I'm incredibly interested in. It's also highly relevant to all of our teams. So we're going to talk a little bit about what product market fit is specifically in blockchain, and then move to, I think, the more relevant topic for many of our teams, which is how do we get there? How do we even start on that journey to get there and figuring out that roadmap? So how would you define product market fit in blockchain?
I would obviate the word blockchain and just say, how do you define product market fit?
Okay.
Product market fit is the same thing no matter what segment of area that you're building in. So product market fit, very simply, is when the market wants what you're building. That's it. That's what it means. It means the market wants what you're building. And there's a very strong sign generally that you're achieving product market fit, or that you've gotten product market fit, which is that your product is flying off the shelf. Inquiries are coming faster than you can handle it. The market is pulling something out of you. The market knows exactly what it wants, and you have it. That is product market fit. And so when you start to see, okay, I'm getting some customers, or I'm getting some BD deals, or I'm getting something done, it's a sign that there's someone out there who wants what you want. There's someone out there who's willing to work with you, maybe because they think maybe they want what you want. Or sorry, they want what you have. But it's when you've hit exactly the bullseye of this is exactly what the market is clamoring for. That's product market fit. And if you don't have it, you know, and if you do have it, it's unmistakable.
Awesome. So I think that's a great overview of it. I think for many people, the question is actually defining what a lot of these things are, which is like, what is a market? Is a market is users across different sectors? Is a market many users that are similar to each other within the same sector? So how would you also like drill down and define like the markets that someone can understand? Okay, well, I've got 20 different users that use me for different things, or I've got one set of users that use me for one thing, or it's a bunch of like developers that even though they're in different markets, they're, yes, if you could share some light on that.
Yeah. So generally speaking, as an investor, when I'm thinking about a market, I'm thinking about how to size a market. And you don't think of sizing a market in terms of people generally. You think of it in terms of revenue, in terms of value, in terms of dollars. The reason why we don't think of markets in terms of users versus in terms of numbers is that users are very different from each other. So if you have, take for example, something like Axie Infinity. Axie Infinity has 500,000 users, and those users are mostly very low income people in emerging markets, right? And so the average amount of money that a single user for Axie Infinity can pay is on the order of, less than $1, right? So these are very low monetization users. On the other hand, Uniswap has many fewer users than Axie Infinity, but Uniswap, the users who are using Uniswap have a lot more money that they are spending on Uniswap every single day, and a lot more they're willing to expend in fees. And so that's why, even though Uniswap has fewer users, those users are worth a lot more, and the value being created for those users is much higher. So you want to be thinking of a market, if you can, in terms of a monetary figure. That way you're normalizing across different use cases, and even for the same users, and also the relative value of those users compared to other users you might target. Now, that being said, if you're thinking about, okay, what is the market size for something like a developer tool? Okay, well, it's hard to tell because you don't exactly know how much people are willing to spend. Right now, people don't spend a lot on developer tools within Web3. You might think, okay, well, someday in the future they will, even though right now they're not really spending that much. And so these things become more nebulous as you're getting farther out in terms of people are not showing a willingness to pay for this yet, but my conviction is that someday they will. So how do you define a market? The core question. It always depends on your product. But you want to make sure, one, that your market is measurable. So you have some way of getting a handle, even if it's just users, even if that's your best approximation, or if it's applications, maybe that's your best approximation, or if it's companies, maybe that's your best approximation. But you need to have some concrete sense of what your market is. You want to be able to size that market, and you also want to know, is their market growing? Because if you are building a product for a market that is not growing, and especially for a market that's shrinking, oftentimes that's a sign that this may not be a market you want to go after. Because by the time your product reaches maturity, that market might not be sufficiently big to be interesting or compelling for you to go after.
Awesome. How do you think about it in terms of markets that perhaps are currently stagnant but will grow in the future? So let's say that the DGen crypto trading market, which right now isn't growing at an a year ago or 2 years ago it was growing exponentially. Now it's obviously not. in the future it will be. We don't know what that time frame is.
So this is a very deep question. It's a question about what if I have conviction about where the market is going? What if I have conviction about something that will change in the market? The standard advice in Silicon Valley is do not assume you know the future, right? Look at the present, look at the snapshot of what's happening right now, and build a product that will actually get users right now. And I think in general, this is good advice, even in crypto, if anything, especially in crypto. And the reason why I say that is that for startups, users, you cannot build a startup without any users, okay? Why not? Because feedback is the oxygen for startups. Without feedback, your startup will die on the vine. And the only way you can really get feedback, true, genuine feedback, is from users using your product. If you are building in a vacuum, if you're building just for some generic, vague idea about some user that will eventually arrive or some use case that will eventually demand your product, you are basically building with the lights out, where you can't see even your own hands as you're trying to build this edifice that you assume someday is going to be really valuable. And so even if you are right in your conviction that someday, for example, there are going to be AI agents and those agents are going to need specific tooling and blah, 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 blah. You have this very, maybe even plausible, but this multi-step thesis about how your product is going to get used and find its customers. The problem is that even if you're right, the chances that you are going to build that product correctly at a time when those customers don't exist is almost zero. Even if that product will eventually exist, the person who's going to build it is almost certainly the person who is going to build it when the customer is there. And they'll actually be able to get feedback from those customers, whether they be, crypto degens who are not trading today, but they'll be trading in 2-3 years, or the future AI agents or whatever that can give you feedback on how they like your product. Now that said, I would walk that back a little bit in that the idea that there are no crypto degens today is obviously false. There are crypto degens today, so you can actually build for that audience today. But if literally every single crypto degen disappeared, there was like an extinction level event and they were all gone, I would say do not build for that market. Now, maybe you're right that interest rates go down or there's another crypto cycle or Bitcoin halves or whatever, and you have your pet story about why it is that the market is going to totally change. And maybe you're right, and I even agree with you that will eventually happen. If your customers are not here today, then you cannot build a product for them.
Right. Awesome. No, but part of the question was, you mentioned if it's not a growing market. So you can build for them. Do you think it's still a good idea to build for them right now if it's not a growing market? It sounds like if you have conviction, then it is. Or would you say,
I think if you have conviction, it's fine to build for a growing market. You want to make sure you have a good reason for believing this, right? And I can't give you generic advice on how to predict future trends, because it's essentially what you're doing is you're saying, look, I have some insight into future trends that the rest of the market doesn't know. If the market is telling you that this trend is coming, even if the data is not yet there, then I think it's much more de-risked to do that, right? So for example, there's a lot of stuff in AI that's getting a lot of market cap, even though the AI use cases and the revenue is not there yet today, but the market's projecting forward and saying, look, I can see this AI stuff is coming and it's going to be big, right? So I think it's very defensible to say, look, I'm going to build something for future AI products, even though those AI products aren't here today, but you can look at this. The market is clearly showing you this stuff is coming and the market agrees with me. As an investor, I'm going to find that much more compelling than you tell me, well, look, I have this thesis, and you do the Charlie from Always Sunny in Philadelphia thing where you just build this crazy web of, oh, well, if this happens and this happens and this happens, and then my product is going to get users. As an investor, my default, if I don't already disagree with you, is to discount any complicated story about how your startup is going to eventually get users when it can't get users today.
Right. Awesome. I want to bring this down to earth a little bit more. What are some examples of blockchain projects that either you've invested in or that you think are in the market that do have product market fit? And what was a point that you think it was clear that they had that, right? So Ethereum, Uniswap might be some, but you mentioned Axie. Do you think Axie has it? Would love your thoughts on kind of as a project is growing, what is the point that it's oh, this is where I should continue versus this is where potentially I should reflect and pivot?
So one example that just recently came to mind was Blur. So we were investors into Blur before their token launch. So for those of you who are not familiar, Blur is an NFT exchange. They basically allow you to trade NFTs at significantly lower fees than you could on OpenSea. And it's designed more for professional traders rather than for kind of, mom and pop, kind of off the street, Gen Pop style NFT traders or NFT speculators, let's say. So Blur was a product that very quickly started getting traction, particularly among high volume NFT traders. So NFT trading, it's a market where generally there are the kind of, casual speculators who are point and click buying stuff based on how they feel and just kind of looking at this thing like an eBay. And then you have these professional traders who are trading very high volume very quickly. Oftentimes they're using automated tools. They're looking at charts. It's a very different kind of activity for these high volume traders. And these high volume traders do most of the volume. So it's very similar in a way to what you see in Coinbase, for example, where you have these hedge funds that are doing most of the volume, even though the reason why they're there is that there are these retail traders who are don't have as much alpha as the hedge funds. So they had a conviction, they had this thesis that the NFT market was not being, there was no product that was sufficiently well suited for these crypto high volume traders in NFT land. And so they built this product under the idea that we're going to build this not for normal users, but we're going to really segment to particularly around these high volume professionalized traders. And when they launched this product, they started off with a fairly small distribution, started getting users gradually, and the users really loved the product. They were using it a lot. You saw these power users who were doing lots and lots and lots of trades through Blur. Even though it was a relatively small number in the very beginning, they could see that among the users who were using Blur, all of their trading activity was going through Blur. And if anything, it was actually increasing the amount of trading activity that they were doing. And that they took as validation that, aha, this product is working. The customers we want to go after, they love this product. Now it's a question of how do we scale it up and how do we get distribution? And that's what caused them to eventually launch a token, use liquidity mining slash trade mining type techniques in order to attract more users to the platform. And now, any given day, they actually do more volume than OpenSea, which at the time was by far the dominant NFT exchange. So that's awesome. a fairly straightforward story about how a particular product can take off. Now take Axie Infinity on the other side. So Axie Infinity, I think, is an example of where this kind of thinking can go wrong. Ostensibly, you might think of Axie Infinity as like, well, that story sounds kind of similar, right? They created a game, people started playing the game, they started making money because Axie Infinity had these play-to-earn mechanics, such that if you played the game, you could potentially make more money if you, farmed your assets and sold them at the right time, farmed more Axies. And it started growing, and it was growing and growing and growing and growing. And the token mechanics made it even more viral than it was before the tokens really, before the prices were really starting to shoot up. And soon the growth chart for Axie Infinity just looked incredible. And that was around the time that all the VCs started pouring into Axie, and the narrative started really gaining a lot of mainstream attention. Now, Axie Infinity ended up having a very different outcome from Blur. Blur today is still the dominant NFT exchange. Despite the fact that NFT volumes on the whole have gone down a lot, Axie Infinity has not maintained their position in Web3 gaming. Their metrics have gone down tremendously, and the token price has gone down tremendously, and the retention of the game is quite poor. And I think a lot of the reason why this is that in crypto, especially when you're launching a token-based project, it's very easy to obscure signals of product market fit when you are using these very aggressive token-based virality mechanics like play to earn or like liquidity mining or trade mining. I don't know if we have time to really go into why this is, and I'd be happy to elaborate on it if valuable. But very often, what we encourage founders to do because of this is to start kind of the way that Blur started, which is start without juicing your numbers, without juicing your metrics, using these kind of growth mechanics with tokens or incentives to use the product. If your product without incentives shows that the core users that you're targeting like your product and want to use it for its own sake, then that's a sign that, okay, you've built the right thing. Once you've built the right thing, then you can, sort of sprinkle on this magic pixie dust of token mechanics in order to make it more attractive and juice your growth. But before you actually know the product itself is sustainable, you can pour these mechanics on almost anything and get some semblance of growth, but that growth is not going to be sustainable. And that's what you saw in Axie Infinity and many of the play-to-earn darlings of 2021 and 2022.
Awesome. So really the difference between customer acquisition and churn, and customer acquisition is important, and obviously accelerating that is great. But if you have high churn, then that's not product market fit either. And kind of in Blur, you kind of were able to see that level out and have a set of users that continued to use it and persist to use it and increased the number of transactions they were having on Blur. And I was looking at DApp Radar, and it looks like in its heyday, like ignoring the spikes, they were at 11,000 transactions or something per day. I think now it's still at around 6-ish, even in this market, and it's stayed relatively stable in the last 6 months or so.
Yeah, that sounds right.
Okay, awesome. Do you think that the best technology always wins? And if not, why not? Okay, and then so why not? What are would love some insight into that.
So the best product generally wins. That is not the same thing as the best technology generally wins. So product is about more than just technology. Product is about how the technology is given to an end user, what their experience is of interacting with this thing. Also, your integrations into other products that are adjacent to it, such that, okay, maybe one might say that a particular blockchain is better than the EVM. The EVM is the virtual machine that Ethereum uses. EVM is slow, it's clunky, it's got all these problems, it's insecure, whatever. It's not optimized for modern hardware. And so you might say, like, well, this is better technology than the EVM, therefore it should win. But the reality is that the EVM is not just the EVM. The EVM is also all of the adjacent integrations and all the things that become easy, all the partnerships that fall in your lap, all the things that are no longer hard because everyone is using the EVM. And so if you take a broader view of what product is, you take a broader view of what technology is, then I think you could say that it's a little easier to understand why it is that the best technology doesn't always win. But go-to-market motion, sales, distribution, marketing, all these things matter. It's not just a question of unidimensional best technology wins. It's never been true in any domain, and it's certainly not true in crypto.
Awesome. So that a perfect segue into how do we get to product market fit, and especially at this stage, many of our teams. I think I mentioned we have tons of PhDs in a lot of these teams. They've built compelling technologies, solving a lot of the problems with scalable, verifiable compute, with data availability layers that are 100 times faster, with block explorers that are faster to generate and can do more. But the big question for them is, who should they tackle? How should they tackle it? What market should they look at? Should they be looking at Web 2? Should they be looking at Web 3 markets? If you're doing like verifiable AI, there's a huge space of verifiable compute in the Web 2 space right now. Obviously, there's also a market within Web 3. So should they look at more retail-focused developer market that is more based on kind of small users, or more design partner-focused kind of smaller number of users that you can have design partners on? How should they be thinking about that, or what type of advice would you give to teams when they're in this early stage?
So again, it always depends on the particulars of the startup and the market they're going after. But the best generic advice I can offer is you want to start small. You want to start by biting off exactly as much as you can chew and swallow. And generally what that means, I think design partners are a good way to model that, which is to find somebody who is your stereotypical customer. Somebody who you think, this is the person that if I can build a product they love, that many, many, many other people will want my product. And build a relationship with that particular partner, and then make sure that what you deliver is fantastic for them, but also general enough that it can extend to other potential clients beyond just the person that you're building for. So if you're building a block explorer, right? Who is the customer for block explorers? You can imagine, well, the customer for block explorers is consumers, right? Consumers use the block explorer. But that's actually not true. Who's paying for the block explorer? Well, usually the person paying for the block explorer is not the consumer. Consumers don't pay for block explorers. It is actually protocols that pay for block explorers. So, Ethereum, obviously, it's, Etherscan just sort of did their block explorer as a public service, and they monetize separately with ads and other things. But most of the block explorer business is people sell the block explorer services to other layer ones. So they sell it to Avalanche, they sell it to Polygon, they sell it to Optimism. They say, I will launch and maintain a block explorer for you that gives you an Ethereum-like experience. Okay, so if you understand that properly conceived, your design partner should be a layer one. And maybe, look, it's hard to get their design partner to be, Optimism, because Optimism is big and, they've got a lot of stuff going on. But find some small rinky-dinky L1, just something that will be willing to sit down with you, spend time with you, give you feedback, really work with you in figuring out what exactly do I need to build to make this a way better experience of partnering with my Block Explorer as opposed to anybody else's. And really spend the time to nail that first before you worry about, okay, how do I go to market? How do I build a sales team? How do I blah, 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 blah. So one, you want to make sure you really understand who your customer is. That's not always an obvious answer. And second is that you spend a lot of time with a stereotypical customer or with as many of those customers as you can in the early days and really iterate with that customer. So if it's an end user, great. If it's a trader, great. If it's a DGen, great. If it's a protocol, great. But you need to make sure that you find somebody who can give you that really tight feedback loop and is working very close with you to make sure that this product is fantastic before you end up pushing it out into the world.
Awesome. I love this. So to that end, right. So know your customer, spend a lot of time with them. I think there are, especially in blockchain, kind of two broad types of projects. The one kind of as you described, where let's say you're building a Block Explorer, you have a very clear idea of who your customer is. What if you're building something that's like a cross-chain liquidity? There's a scenario where you are building for traders. You can't necessarily build for 2 or 3. The entire system is predicated upon network effects and liquidity. How do you go about understanding who your users might be there, getting users? Is this something that you build out in the open and you try and kind of create some sort of community? Or do you just build it and hope that people come? How should you approach a more platform play that requires an ecosystem of multiple participants?
So generally, my recommendation when you're taking that kind of approach, you're building really pure infrastructure that connects up to a bunch of other stuff, and there's no one single type of party. It's like, okay, I need traders and I need miners and I need this and I need that, and all of them need to work with to choose my solution. The first thing I'd say is that you still want to take the same approach, which is you want to think about who is my stereotypical A, my stereotypical B, and my stereotypical C, and I'll make sure I always keep these people in mind as persona that I'm building this for. So if you're like, look, I always need to be attendant to the needs of miners, then okay, have a miner on hand, or somebody who you know that you can work with and talk to and really model how they think and what they care about. Because if you don't have this thing in mind, if you don't have this voice on your shoulder that tells you what this miner thinks, you're not going to be able to very clearly build the right thing for them. And second is you want to keep them engaged as to your progress in what you're building, right? And you want to make sure that, if you can, so a very common technique in startups is what's often called the Wizard of Oz approach, where basically you pretend to have built the real thing even though you haven't actually built it yet, right? So one example is, let's say you want to build an AI agent startup. So you want to show people, oh, okay, here's an AI personal assistant. It'll like book your flights and it'll do this and that for you. And the question is, do people want this? Are they willing to pay for it? Well, the Wizard of Oz approach is you just pretend you already built it. And you say, aha, we have this product and it costs $30 a month. And it'll be your AI assistant. And people sign up for it, and you only let a few people sign up for it. And the AI assistant doesn't exist. It's literally just you behind a chat interface, and you pretend to be an AI agent, and you book their flights, and you just see, do people actually like this product? And if they do, okay, cool. Now this validates that if I build it, people will give a shit about it, right? And so I think this can often actually be done with infrastructure. Is if you show somebody, well, here's what the flow will actually look like. Right, you click this button and then it like does this little whirly thing, and then in about 15 seconds it'll be 3 blocks because of blah blah blah. Then your money will move over here. Look at this is what it would feel like. This is fake. I bullshit everything, but would you actually use this? Is this actually desirable to you? Now, sometimes the answer, like you mentioned, is that look, it's only useful to me if everyone else uses it. And then you really have a product that it's not the product itself; it is the network effect that is the thing that you're selling. And sometimes there really are those kinds of businesses where the thing you're selling is a property of the system, not the experience of the system. And in those cases, unfortunately, there really is no way around. You just have to go build the infra and build those relationships as you are shipping the infra and getting it farther and farther along. Those are the hardest startups to build in many ways because of the fact that you don't get a lot of feedback before you're done. So traditionally, in traditional venture, this is often how people perceive hardware startups. Is that hardware? It's very hard to iterate because the end-to-end thing until you actually get a piece of hardware in front of you costs a lot of money, a huge amount of investment, lots and lots of R&D before you can finally get a thing to play around with and show a customer. I think a lot of infrastructure startups in crypto, they feel like this, which is that there's a lot of R&D spend, huge amount of investment up front, and you don't really know until the end, is this actually a product that people want? Is this actually something people would use? And so if, again, you can get those proxies of, okay, does this look like this is a product people would use? Does it look like even a weaker version of this is usable for users? I would try to get those signals earlier on rather than waiting until the very end. But if there's no choice, sometimes there's no choice, and you just have to bite the bullet and build a hard thing.
Yeah. So I love this because it also speaks towards there's an approach that building things initially centralized, which is like building the back end, so to speak, or multiple parts of the party in a centralized capacity, being able to test that out with a set of user personas, validating that, and then kind of decentralizing versus, I guess, if you can't do that, would you approach this with perhaps building more in the open and having building more community, telling people what you're doing and getting validation that way, so to speak? Or
so anything that you're doing on chain, I broadly recommend building out of the open and trying to get community involved into what you're building, especially if you're going to be launching a token. It's very important, I think, from the very early days to try to get that transparency and community orientation to what you're doing. If you're building another kind of product that is not, an on-chain type thing, so for example, you're building a block explorer, don't bother, right? Just spend time with your customers, whoever they might be.
Right. And what are your thoughts on, I guess, early days? If you do build in the open too much, is there risk of existing competition copying you, et cetera? Like, what are the considerations? At what point should you open things up? Should it be from the very beginning? Should it be once you've reached a certain level of maturity? Because this is another question that many of our teams have. Like, at what point should they publish everything? Should they open source a part or most of what they're doing?
Yeah. So in general, my view is that history does not have a lot of examples of people who messed up by being too transparent. Actually, I struggle to think even of a single example of somebody who their error was that they open sourced something or that they built out in the open. I can think of a lot of people who their error was that they were too close to the chest. They did not bring in the community. They were too narrow or too protective of what they were doing. And so now there are times when you want to be more cautious. Like, for example, you're currently pre-audit and you have some concerns about security vulnerabilities, et cetera, et cetera. But in general, if you're building on chain, especially if you're building in the Ethereum community, your default should be build out in the open, build open source, and don't rely on secrecy as being a moat. If you build a great product, doesn't matter if people fork you. I can't think of a single example, literally a single example of a time that a fork has overtaken the original. I've been in the space for many, many years, more than 5 years now, and it has just never happened. The only time I can think of that a fork actually overtook the original is Monero. Monero was actually a fork of another blockchain called Bitcoin, which it's a long, long story. This is like, the 2012 or 2013. But that's the only example I can think of where a fork overtook the original. Basically, almost never happens. And for that reason, I think it is not worth worrying about. The benefits of building in the open and having real community and real engagement and real support is so much higher than the potential cost that somebody is going to care and is going to copy your idea. It's an old trope in Silicon Valley that ideas are not valuable. The thing that is valuable is execution. It's actually implementing an idea. And so the thing that is hard about Uniswap was not X times Y equals K. A bunch of people copied X times Y equals K, and nothing that they built is anywhere near as valuable as Uniswap. The thing that was hard about Uniswap was how they did it, the way they did it, and their ability to keep doing it, to launch Uni v3 and launch Uni v4, et cetera, et cetera.
Awesome. Super helpful. To go back a minute on kind of it, you mentioned thinking about your stereotypical like persona, customer A, customer B, customer C, especially in the early stage. You can go after all of them at the same time. You can go after each of them sequentially. At what point should it be more exploratory and try and get a Web3 customer for verifiable computer, a Web2 customer versus, or if you're a payments company like B2B payments, B2C payments, cross-border payments, what point should you be more exploratory versus what point should you hone in on, okay, I'm just going to build for this one customer persona, and then at some point pivot and iterate?
So when you're first starting, you want to be exploratory, right? So there's, if you don't really have strong conviction about where people are most in need of what you're trying to build, then yes, early on you want to start exploratory and you don't want to pre-commit to, okay, we're going to be a B2B startup, we're going to be a B2C startup, we're going to be B2B2B, or sorry, B2B2C. All these options you should be open to as you learn more about the market. But the more you learn, the more conversations that you have, the more you should be honing in toward, I can see from these conversations, it really feels like this is where the market is strong. There's a lot of demand here. People can tell us, they're telling us something that sounds very close to what we're trying to build. And I have a conviction about the size of the market and the growth of the market, right? Those are the things that I would be looking for early on. But you want to make sure that as you're getting closer to actually building stuff and iterating, then you want to be narrowing and narrowing and narrowing until the point where you're almost too narrow. I would almost never tell a startup you're being too narrow in your market. Almost always the feedback I give to startups is that you're too broad. So in general, it's very hard to make the mistake of, I'm too specific about my customer.
Okay, and as they narrow down and start to build for a specific customer segment, what kind of validation is usually strong validation to keep going down this road versus validation that perhaps it's time to pivot?
I mean, the number one piece of validation, the problem when you spend a lot of time with customers is that the people you're going to spend time with are people who like you. And when people like you, they are not going to tell you the truth. So this is the iron law of startups. So if you ask your mom how your startup's going, she'll say, oh, it's great, honey, you're wonderful. If you ask your best friend, they'll say, oh, it's so great that you're taking risks. Like, I always believed in you. And if you ask the customer that you've been spending a lot of time with, that customer is going to tell you nice things. So the number one rule of figuring out what is real feedback and what is people bullshitting you is, will they spend money? If they will spend money, then you know they mean it. And so I would, now early on, of course, you're not going to ask them to spend money because you don't really have a product yet. But as you get closer and closer to something, if you can get commitments from the people you are building for, that they will actually put money down and spend real money for the thing that you're doing, then you might have a ghost of an actual product that is worth building. But until then, if all the feedback you're getting is verbal, of, oh, I like this, I can totally see spending money on it. Seeing spending money on it and spending money on it are two very different things. So you want to be always cautious that the people you're spending your time around are bullshitting you, because they will. So that is something that I would always be vigilant against as you're trying to ascertain, do I really have product market fit, or are the people I'm talking to being nice to me?
Awesome. So, right, are they willing to spend money? And if you are going, I guess, in a more retail or broader focused of like high volume transactions, I guess you need to charge them in some way or form. So design partners is easy. You can have some sort of kind of business model that is temporary, like, will give me X to build this for you. As you're going to a broader market and you're launching something that's kind of high transaction volumes, you just charge them transaction fees. Obviously, you don't want to start with your own token. Do you use someone else's token?
Yeah. So look, I would take the idea of pay for this in a broad sense, because not everything is directly like, okay, you pay me some fee for this service. Sometimes you should think of it. I think the best way to think of it is in terms of they pay for it in opportunity cost. So for example, let's say you're building an interoperability network. How do you charge someone? Well, it's like, look, I actually, what I need is integrations, right? If people integrate me, that costs developer time. That is the opportunity cost that people are willing to pay to show me that they value what I'm building. If they're not willing to actually spend the developer time to build those integrations into their own chains, then they don't really care, right? And so that's not them paying you, but it's them paying something of value, showing you that your startup is worth it. So that's what you should be thinking of, is opportunity cost, as opposed to necessarily they're giving you money and you're cashing the check and et cetera. You might not even be able to do that at inception if, there's obviously there are a lot of constraints to actually receiving payments for different kinds of products.
Awesome. And one last question on this, like, when you're looking at a specific segment or a specific user persona, at what point should you determine, is it is it the persona that's wrong, or is it that I just haven't been able to build the right thing for them yet, and I should keep doubling down and trying to kind of add more features or capabilities to better create value for them?
I don't think there's a good generic answer to that question. I think that's
Okay.
one of those things that, yeah, that's hard. It's a hard question.
Yeah.
And you just have to battle with that hard question as you're figuring out who should your customer be. The other thing I would say, kind of jumping off a little bit from that question, is that a mistake that people often make in crypto is they look at the loudest voices and they assume that the loudest voices are telling them something important about the market. Very often, the loudest voices in crypto are not representative of the market. So what I mean by that is that, if you listen to Bitcoin influencers, they're very loud on Twitter. They talk a lot, and what they'll tell you is that never custody your keys on an exchange. Not your keys, not your crypto, blah 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 blah, all this stuff. And you might think like, wow, these people are really loud. They have big followings. I should build a product for people who don't want to custody their keys on exchanges. Problem is that if you take these crypto advocates at their word, you would have a very bad understanding of how people actually use crypto. The vast majority of people who use crypto use exchanges. And if you build for influencers, the reality is that influencers are not like normal people. And these influencers don't actually do very much volume themselves. So it's not a real market, right? So you want to be careful not to mistake what the influencers are saying from what normal people do. In the same way, if you're thinking like, wow, okay, the whole world, if you're thinking normal consumer products, right? You might think like, wow, most people are very religious. People believe in God. And so I'm going to listen to what the Pope is saying. And I'm going to build products based on what the Pope is telling me that people do, of like, oh, nobody should have unprotected sex. Oh, great. We should, they would give you a very poor idea of what people actually do. And so I think the same thing is true in crypto. Don't make the mistake of thinking that influencers and people who are very loud are representative of what normal users do. Find normal users and model your behavior on the stereotypical user of your product rather than somebody who is influencing the stereotypical user of your product.
Awesome. So from everything you've described right now, it seems like if you're able to find a few design partners that can get bought into what you're building and support you in that, that's the easiest way to get validation. The other side of things is if you're building for a broader market, a more consumer-focused market, it can often be harder in some ways because you have to somehow make sense of all the noise. Do you think that that's then skews or should skew ventures to looking more at this kind of easier option of design partners and starting off with a more B2B-ish type of approach or type of customer persona?
So it's a very common perception in venture generally that B2B startups are more predictable than B2C startups. Because of course, consumers are fickle and it's very hard to think about what everybody in the world wants as a consumer. But it's easier to think about what companies want because companies are they're a little bit more monotonous. They're a little bit easier to model and to predict exactly what they're going to want when. And that's also true in crypto. That being said, it's very clear the biggest outcomes in crypto, the biggest startups, the most successful ventures, all of them are B2C startups. There is no big B2B winner in crypto. So if you think about the big L1s, the big DeFi protocols, the exchanges, everything that's been really tremendously, amazingly successful, almost all of them involve directly going to consumers. And it's also true in traditional venture as well, is that if you look at the biggest companies in the world, you look at the Apples and the Googles and whatever, these are not B2B companies, these are B2C companies. They build things that people want. So that should temper, I think, your sense. It is true that if you want something that's easier to understand and less confusing, B2B is simpler. It's less confusing. It's easier to model what a company wants than what a throng of tens of millions of people want. But the prize for figuring out what people want is bigger than the prize for figuring out what businesses want.
To, I guess, again, try to bring this down to earth, because we've been talking a lot in abstracts, and that's my fault for pushing things theoretically. Like we have literally different types of products that people are building, right? There's decentralized applications, which are very much consumer. There's decentralized infrastructure, which is almost like B to developer, so to speak. And then there's B2B, similar to your Block Explorer. Should the complexity of your product and your ability to iterate that product kind of determine which you should potentially go after? Meaning, if it's easier for you to change your product, you can go after B2B. If it's harder, maybe you should go after a more developer or consumer focus and pivot on different segments within that. Or like, how would you think
I would
about...
not think about it that way. I would not think about it that way. like the question of what is the problem you're solving should come before even the product itself. The question is always, what is the problem you're solving? If you don't know what the problem is you're solving, then you need to start over. You need to put aside the products you've been building and instead just really hone in on this thing. What is the problem that I'm solving? Okay, once you've articulated the problem, who has the problem? If this is a problem in the abstract, but no one actually has the problem, then you're probably fucked, right? You need to find some identifiable person who actually feels this problem and is willing to use a product to solve this problem. Now, once you've found that, once you've started with the problem, you found the people who have the problem, then you can go about addressing a particular product to those people who have that problem. And there may be a category of people broadly who have this problem, right? It could be companies have this problem and consumers have this problem and developers have this problem. And you might, target the product a little bit differently based on which of these three segments of people who are facing this problem you might try to address. But if you're starting from, okay, I built this thing, who do I give it to? Who wants it? You've already fucked up. And I would take 2 steps back, forget what you even built, and start just from the ground basis. What is the problem in the world that I'm trying to address? And work your way forward to a product, not backwards from a product.
So the challenge you might have here, though, especially in the blockchain space, is that it's still early and many of these markets might not exist. So if I take the example of a data availability layer that might be 100 times faster, well, maybe the existing data availability layers are sufficient for the current use cases, because more complex use cases, say like fully on-chain games, people just kind of said, well, we're just not going to do it fully on-chain because the tech can't solve it. So no one's necessarily, hypothetically, no one's necessarily trying to build that, but you enable that. Like, I think many of these technologies, especially in reducing cost performance by orders of magnitude, enable net new things. How do you go after the people that might want to build that?
So it's a great question. Here's what I'd say. There's 2 different ways to look at this. So the first is that I don't think it's true that your customers are not here yet because, well, nobody needs 100 megabytes per second of throughput on a data availability layer today. They only need 10 megabytes per second. Therefore, nobody really needs my product. I don't think that's true. I think that's a function of you not sufficiently well selling your product to the people who might otherwise need it. If you are a roll-up and the rollups are like, well, Celestia is good enough for me because I don't really need more than 1 megabyte per second or 2 megabytes per second. What you should be telling them is that, motherfucker, yes, you do, because every other rollup is thinking the same thing. And pretty soon, within a year or two, we're going to have fees on that data availability layer going through the roof because it's not going to be able to scale its data throughput faster than people are going to want to use it. So what you need is a future-proof data availability layer. That is what we are selling. That is what we have. We have something much better that you're going to hit this bottleneck, not in a year. You're going to hit this bottleneck in 6 months. As soon as this thing is robust enough, like, blah, blah, blah. This is a sales motion. This is you convincing your customer that the problem they think they are solving with another product, they haven't actually solved. They need your product to solve their problem, right? And if you can't convince them of that, you are not selling well enough. That is the ultimate answer. And it's generally not going to be the case that people are going to choose a worse product for no fucking reason, right? They might choose Celestia. If so, why are they choosing Celestia? And you need to really drill down. Okay, we've got 100 megabytes per second throughput, but what is the thing we don't have that Celestia has? Figure that out and figure out how you can address that objection within your consumers, such that you can be side by side with Celestia the better choice. Now, okay, that's there's a second example you gave. I forgot what it was now.
I'm actually forgetting as well, but even on that, I'd like to just double down or dig a little deeper. So would you say that you should go after Celestia customers and eigenlayer customers or eigenlayer DA customers, or would you rather go after net new customers that haven't necessarily chosen a data availability layer? Should you compete where existing people are? Or should you find a separate niche initially?
So I think both are reasonable answers. It really depends on the particulars of the market, how hard it is to compete on those deals, and your overall strategy. In this case, in particular, if you're talking about a data availability layer, I would say you should go after the big dogs as soon as you can, because I do think there's a lot of lock-in for data availability layers, right? It's not the kind of thing that you can very easily say, oh, okay, I'm dumping all my data onto Celestia, and then 2 years later, I'll change my mind and dump my data here. You can in principle, but I think it's one of these things that people will just pick one and then they'll move on and they'll not think about it. Now, it's hard to compete day one with Celestia when Celestia has a lot of resources. They're very well known. They've got all this meme energy. You're probably going to lose most of the deals if you're competing head to head with Celestia, but you might win a few. And the few that you win are going to be your wedge into the market. If instead, now you can always go and say, look, this is not my comparative advantage, right? Celestia has this great branding. They've got all these relationships already. People have already started integrations. And so it's going to be very hard for me to jump in there this late in the game. And so one thing that I might do instead is say, okay, who can I win that Celestia can't win? What is my niche? The problem, I think, with going down that road is that I'm concerned that niche might be too small. And if you're only targeting that niche, it might not be a big enough market to be interesting if you don't actually go compete in the big juicy market, which is all the roll-ups and all of the other folks who want to use data availability, in which case you kind of, in general, one thing I generally recommend to startups is don't be afraid of competition. Now, be strategic. You don't necessarily want to, go rushing guns blazing into the battlefield if you have a better strategy of, sitting atop a garrison and, mowing people down with a sniper rifle. If you can do that, yeah, you should go do that. But if it's hand-to-hand combat, then it's hand-to-hand combat. And you should not run away from the battlefield just because you think you're likely to lose. That's okay. You're going to lose most of your deals against the incumbents, especially early on. But that's how eventually you get to the point where you start winning, you start building momentum, you start getting more partnerships, and you build yourself into something bigger and more powerful.
Yeah, I think it's an interesting balance you bring up between going after that niche and being able to actually build trust and show proven performance, but losing time with respect to kind of that larger market share versus going and trying and competing with significantly larger players when it might be more difficult for you at that point. But you are able to cut potentially, if you do win, you can get there earlier, and it's kind of balancing one versus the other. All right, we have 3 minutes left. I think we've covered most of the topics that I wanted to cover. Does anyone in the chat have any questions?
Questions, anybody?
And if you do, just write it in the chat.
I think everyone learned so much, they're just digesting.
Yeah. Question, I guess, last question. Any thoughts about this? And I love asking. We're in a difficult we're in a difficult market right now, right? It's obviously affecting what people are building, how they're building, and what their priorities are. Any thoughts that you want to share about kind of building in this bear market?
Sorry, can you repeat that? Any thoughts around what makes me not want?
No. About what people should be focusing on more, or in building in this bear market, in the current bear market, right? Obviously, not NFT trading analytics.
Yes. What do I think people should be focused on building? So look, as a VC, I generally don't like to be in the business of telling people what to build and what not to build, because I don't know. Anybody who claims to know is either fooling you or they're fooling themselves. So the number one thing that I would say is you really want to build a view on where all this stuff is going. And you want to be about 6 months to 1 year early. That's the sweet spot. 6 months to 1 year early. You don't want to be 2 years early. If you're 2 years early, you are just going to be wandering through the desert without any sign of life and without any direction. And if you're late, then it's really, really hard to actually build enough momentum against the incumbents to make a lot of progress. So the number one thing is find something that you are pretty sure is coming and start building a product, start building in an understanding, start putting together a team and a real, start making real progress on something before it ends up blowing up. Now, how do you know what's going to blow up in a year? I don't, it's hard. Yeah. You have to take a guess. That's why it's called entrepreneurship, is that you have to go take a risk on your own convictions. But that's the way that I would orient you towards thinking about where makes the most sense to be building stuff in this kind of market.
And what's exciting you? What are you seeing now that gets you excited about where this is going?
On a micro level, I think I'm very interested in what's happening with shared sequencers around the rollup stack. I'm spending a lot of time looking at tokenized treasuries and seeing more real world assets finding their way on chain. On a macro level, I think the adoption of stablecoins especially in emerging markets, is really interesting. And that's another place where I think I haven't seen enough startups really try to get some purchase on how the world is going to change when you have more and more people in emerging markets having access to permissionless US dollars. I think there's a lot happening still in crypto. And, look, I was here in 2018, 2019, I was investing through that. That was a real bear market. This, by comparison, is a walk in the park. Like my job is still respectable today, which tells me that it's not that bad. Like in 2017, 2018, that period of time, we all looked like idiots and nobody wanted to mess with us. And it was just like, my friends and my colleagues, they all looked at me with some concern of like, oh, are you sure that you're still in crypto? Everything okay? Nobody does that anymore, which tells me, and of course, like okay, obviously numbers are down a lot from the height of the market, but it's still a very, very healthy place for the industry. There's still a lot of people who own crypto, a lot of people who use crypto. On-chain metrics, there's still $40 billion on-chain from $2 billion just 3 years ago. Crypto is big business now. And there's a lot of stuff that needs to be built for this industry to keep moving forward. So I would just be less somber.
Awesome. I like it. That's a great note to end on. So again, Haseeb, thank you so much. Really appreciate your time. And thank you all for joining us today. We'll share the recording in the next day or so.
Brilliant. Thanks
Take
for
care.
having me.
Have a good
Hope
day.
that was helpful, everyone. Take care.
That was
Bye.
awesome.